All right, so today we're going to talk about liquidity and open interest. A lot of people that I know look at open interest and they're starting to see, hey, which strike should I go with? The open interest here is a little higher or lower. Well, I'm going to answer some questions for you in this video episode. Stay tuned. All right, so I have a lot of different coaching students that I work with, and oftentimes what I do when I look at them is I see them kind of looking at, what's the open interest? What's the open interest? Which one do I go with? Which strike do I go with? Well, in that case, if you're trying to figure that out, I'm going to give you some tips right here to make it a lot easier for you. All right, so we're going to go to this platform right here. This is Thinkorswim by TD Ameritrade. So the easiest way is if you go in and you start looking at open interest and you say, okay, well, I'm going out, X amount of days. And now what I'm doing is I'm looking at, where's the open interest? Right there. Okay, so now I'm looking at this open interest, and this open interest on Microsoft obviously looks fairly good and fairly high. You can see 100, 200. You might say, hey, well, I'll trade the 300. Well, does it really matter? Not really. And I'll tell you why in a second. Getting in a lot of times is not the issue. It's more of getting out. That's more of the problem. So this one obviously is not going to be a big deal. Microsoft is very liquid, but what happens when you get into something like AutoZone? Okay, so what you'll notice is if we go into September right here, there's very little liquidity here. Okay, so you can see there's 9 contracts, 11 contracts, 7 contracts, 12 contracts, that kind of stuff. So it makes it difficult to trade these because really you could look at the further duration, but the most important thing is not the further duration, because you might say, I'm setting up an Iron Condor on 98 days or 35 days. That's fine. It's not going to be a big deal getting into these trades, even though they have 21 days, 21 contracts, 30 contracts, and so on. What you want to check is the shorter term dated option, because that's probably about the time when you'll want to get out. And if these are light with liquidity, then these are going to be a problem. Getting in is usually not an issue. It's getting out that's a problem, especially when things go haywire, hits the fan, and it's just like, oh my God, it's a disaster. So you want to watch the shorter term dated option, like, 10 days or less, even 0 days or less right here, since this is a Friday, but 7 days or less is good. And you can see, okay, well, can I get out? And if the answer is not really, if there's not over 100 or 200 open interest contracts, that's going to be a little bit more of an issue. So let's look at things like a Microsoft. Okay, so here's a Mastercard. You can see these short dated options, 400, 3,000, 500, 3,000, 348, 4,840. So Mastercard's got a lot of open interest out to 7 days, but let's go to the 98 days. You can see it doesn't look as juicy, right? Especially over here, it looks like 47, 27. It doesn't look very open interest. And I find that a lot of people get worried, oh my goodness, it's only got 27 contracts here. That's not a big deal, okay? Because that's further duration. Getting in is usually not the issue. It's more getting out. So looking at the 7 days, as long as there's kind of over a couple hundred, you should be fine. You shouldn't have an issue. So long story short, what is it that you should look at? So check out the short dated options. If there's over a couple hundred, that's fine. If you're trading in the 40, 60, 80 day range, and there's only like 10 or 20 contracts, it's not a big deal as long as the shorter dated has enough sustainability or enough, like over a couple hundred contracts. If the shorter dated options do not have enough contracts, then that one has low liquidity. Now, does that mean you cannot trade it? No, it doesn't. It just means it's going to be more difficult getting out. Again, getting in, usually not an issue. Getting out is going to be a little bit more of the problem. So some of these low liquidity stocks, though, they make some great moves, especially if you're directional in nature. They can work out very well. But I will say that if you're trading kind of options non-directionally and then you're trying to get out of them when you need to, and they don't have a lot of liquidity, that's where it can be a little more difficult. So I hope that was helpful. It gives you some things to think about and some insight, and what to watch for as far as open interest goes. If you want to see some great freebies that I have on my website, click the link right over here or subscribe to the channel if you're brand new. Thanks again, and I will see you next time.